Hey, everybody. Good afternoon. This is Doc Severson, and I've got Dave Lukas here with 12-minute trading. Today is Monday, the 13th of March in 2023. And boy, do we have a lot going on in the markets this week. Not only this weekend, but also going forward into this week and next week as well, too. The fun does not stop. So, Dave, what are you seeing in the markets these days?
It was so like last week, coming into last week, I said I expected us to have kind of just a drift and, just getting ready for the CPI and then the Fed and, wouldn't see a ton of fireworks. And that held pretty good till Wednesday, until Peter Thiel said, I want all my money back, and SVB went down, right? So, I think it's important that I think this topic at this point, anybody's on Twitter or whatever has been covered at nauseum, but I think it is important to understand what is going on here and to understand the bigger ramifications of it from a macro standpoint. So I'm going to start there, and we'll jump into some of these charts and stuff around this, because there's some moves that are coming our way that I think will come out of this. So first and foremost, SVB is kind of a different type of bank, right? They were obviously a regional, they were a big bank, second largest failure in history, but also they were very niche in what they did. They catered to a lot of the Silicon Valley, the startups and stuff, and a lot of those founders and people had their money there and in that and everything, and a lot of those companies. But a lot of those companies are startups; they're not cash flowing. So SVB did a lot of lending to companies like that. And the thing that really got me that maybe hindsight's always 2020, but what these guys did is they locked in 10-year notes and long-term notes like that back when rates were like at 1%, right before the Fed started raising rates. And these guys sit on a Fed board, or they did up until this last week. And so they knew the Fed was going to raise rates, but yet they're locking in these long-term, very low rates in a big way. Like, it's one thing to do a little bit, right? It's another thing to like lock in just tens of billions of dollars. And so that's what these guys did. And that will work fine if you hold to maturity. Like, you're not going to lose anything. Everything's going to be good. But what happened with SVB is that these guys have these long-term rates at these low rates, so they can't pay more on their checking accounts and the money market accounts and stuff like other banks can, who've been doing shorter term and working with the rate structure as it's gone up. And they got stuck. And it started with some people pulling their money out. And think about it. If you're making 0.5% on your account, right, your checking or your money market, and you can get 5% in a CD or in a treasury, why wouldn't you take your money out and park it there, right? If you're just going to be sitting on it, it's fairly illiquid, right? Why wouldn't you do that, or fairly liquid? And so money started to come out of the bank. And what happened is these guys had to cover. And if you know how bonds work, right? Bonds is an inverse relationship. As interest rates go up, prices go down. So these guys locked in all these bonds at 1%. Interest rates went up to 4 and 5%. Their bond prices went down. So they had to sell at a massive loss, and they lost like $2 billion, right? Having to cover essentially to get liquid to cover the deposits. And everybody saw that. And that's what started it all. And that's where, Peter Thiel and a lot of the big VC guys said, get your money out. And it just started a good old fashioned bank run, but it was poorly managed. The bank, they made some bad decisions. And that's what started this whole thing. And so is it isolated to them? Obviously not. We had Signature go down over the weekend. We've got a few others. I think it's isolated to similar banks that are more niche like that did that. In fact, if you looked at the financials for SVB from the last quarter, they're mark to market, meaning that if they sold the holdings that they had on the books, was it like a negative 18 billion? So it showed that they were in the hole, right? So anybody can read a financial statement can see that. So anyway, so that's really what happened. Now it has spread, especially in that California region. Charles Schwab got halted today, Western Alliance, and some of these others. The Fed stepped in and basically threw out FDIC and said, we're insuring everything now. So, I think it's manic. It's typical fear and stuff that happens. I think the markets are fickle, and even people in some ways are fickle to a lot of this stuff. A week from now, it may be forgotten, especially I think if the Fed pauses. And that's where I think this is leading. I think the Fed is going to pause next week, even if CPI is a little higher. I think they may pause and say they'll get back to rate increases in the summer. And I think that's one of the reasons, some of that certainty and that expectation of a pause is why markets are up today. So a little long-winded, but that's how we got here.
So, Dave, if they do pause, is the knee-jerk reaction going to be to the upside, or will it be to the downside for the equity markets?
I think it'll continue the upside because it's not a contagion. We're not seeing this spread throughout the banks. In fact, I saw a great chart that had the risk of these banks, right? And all the ones that were in the bottom corner that were highest risk, those are all the ones that are getting into trouble, right? All the ones that are like lower risk. And you remember, like SVP, a lot of these, they didn't do your traditional customer deposits and retail deposits, right? They worked with like their founders and the business, but they were very much startups and business, right? They didn't have this huge retail center that like the JP Morgans and the Bank of Americas and others do. And again, that's why it's a little different. The deposit structure is just totally different. They were just making really stupid bets long-term with the money, and every bank does that. Everybody I think listening to this knows this, that if you have money in a bank, it doesn't just sit in your account. I always like to say, you've seen It's a Wonderful Life, Jimmy Stewart, your money's in George's house and it's in Jimmy's car and all that stuff, right? That's where your money is at. And then they also take it and they'll buy bonds with it and that sort of thing to get a return and all that stuff.
Yeah.
Right?
Google
so
the term.
The challenge becomes.
Google the term fractional reserve.
Yeah, that's our fractional reserve banking system. It's actually loaned out over 10 times, believe it or not. So if you loan it to Jimmy's mortgage, well, the money from Jimmy's mortgage then gets loaned out on, Larry's mortgage and Jenny and so on down the line, right? So it's basically a bunch of derivatives in the end. That's why we had the financial crisis in 2008. The derivatives blew up basically. And so the big thing is right now is when you get a lot more. When you get a run on the bank, or you get a lot more people than expected wanting money out of their accounts, and you don't have the money there to handle that, right? Well, this is what happens. And so that's just where these guys were at. So I think that as of now, I think the Fed can use it as an excuse to pause, especially if CPI comes in lower tomorrow. If CPI comes in even in line or lower, the Fed absolutely can use it as an excuse to take a pause, let things calm down, then we'll get back to it. They've obviously broken something with as we said they would at some point. The other thing, Doc, I think that's really important to note, rates are plummeting down. Like the 2-year is down 100 points in 2 days. Like literally last Wednesday, you could have gotten a 1% more return on your 2-year than you can today. So it's now below the Fed funds rate. So I think they have enough excuses to take a pause. If they do anything, 25 basis points and maybe then pause. But I think if they keep going, they're going to break more stuff, and they know that. And that's the challenge.
So tomorrow morning, we're looking for a 0.4%, positive 0.4% month-to-month CPI figure. The previous one was 0.5%. So we'll also look for revisions to the previous numbers as well, too, because remember, the past ones, they actually revised higher. The ones that we were celebrating because they were negative, all of a sudden they rewrote those and made those positive as well too. So that 0.4%, so watch for that number. That's going to be the headline number tomorrow, which is going to be year to year 6%. So the Fed's almost there. So yeah, good time to pause maybe.
Yeah.
All right.
So let's get into the charts and talk about how this is working out in the charts right now, because that's we are seriously oversold in some areas, and there's opportunity there. So go ahead.
So we are seeing what I'm doing is I'm drawing the fib retracements from the bottom all the way from that really wild reversal day that we had back on CPI back in October. So we've had, a 4-month rally to the upside, which, peaked out in the 2nd of February. And so we've dropped 50% of that. in a very short period of time. Now, what you'll notice on this too is that we have a series of lower highs, lower lows, and what this is doing is this is just a big weekly pullback. But as long as that weekly pullback stays above this level here at 37.58 or so, 37.60, as long as it stays above that level, then we might be okay. We might start to see this rally. Now, if we do see a rally from here, I think 4,000 will probably reject it and it will drop again. Remember, markets always take the path of least resistance to get somewhere, and actually to go higher, you need to go lower many times. So we are drawing back, and this is almost like pulling back on an archer's bow, and we may get that slingshot move higher, but if it does that, it's going to find some resistance at 4,000. This could be really the interesting point here. If that higher low sets, are we going to move this way, or are we going to just plummet below here? If we get below the 61.8% retracement, that's typically where we say it's going to fill in the triangle. We're heading back for 3,500. So what happens in the next week or so?
If the Fed cuts rates, that's what you'll see. I don't think we're going to see a cut, but if they started cutting rates now, because I've seen a couple things up saying that they're going to start cutting maybe even today, because they had the emergency meeting today that they said they were going to have.
Oh, that would throw too much uncertainty.
Any news off of that?
That would throw too much uncertainty into the market, because people would say, well, what did they know that we don't know?
Exactly.
If something like that were to occur.
We don't want to cut. Actually, believe it or not, when Feds start cutting rates are when markets drop the most.
Now, you were talking earlier about the Russell and what the Russell is doing.
If you pull up a daily chart on that put a Bollinger Band on a daily chart with that and take a look at how this thing is just falling off the cliff. It is so far outside of these ranges that it is due to snap back in. So to me, that's something that, man, I just, it just is really, go ahead. There's the VIX. But if you look at the Russell, look at that, just falling off the cliff. Look at the energy indicator, the fractals on the floor. I mean, we're talking the lowest levels on the fractal that I've seen in well over a year, maybe in the last couple of years. You're multiple levels outside the Bollinger Bands. You've gone almost 8 to 10% down on this thing. And that makes sense, right? These regional banks are in there, but gosh, look at that. I mean, if you look at every time we've had low levels like that being on the downside, right? The bottom Bollinger Band, every time that we have those low levels, we bounce back the other way. Look at that. Look at the one you're on now. Look right above it. Look at that move that came off that. Look at the move that came off that. I mean, this is setting itself up. And the Russell, a lot of times, is that kind of canary in the coal mine. It moves ahead of the rest of the market. So it's gone further down than the rest of the markets, which means the markets maybe overall have a little bit further to go, but it also will lead back the other way. And so this is one of those times where
from a chart pattern,
see that
from a chart pattern perspective, this is what catches my eye here. This is a bear flag.
Yeah.
So we may continue trading within here, but my goodness, look at the energy that we have here. So this is a bear flag, and that's typically a bear. On a monthly chart, a flag pattern shows the halfway house in the middle of a move. So if this starts to break underneath 1,700, we are going to be heading down to somewhere probably, somewhere down in here, because that would be about halfway move from this point. So we'd be heading down to Russell 1000,
1100, 1200.
So I get what
to
Dave,
me, it's a short term thing. I think we get a snapback in the short term is on the daily chart. It's just gone so far, so fast,
right,
that it's due.
Well, this entire bear works off of lower highs. Like, here's a good example where you slam down, get yourself into exhaustion, the price rallies back up, and then it completes the move to the downside. The markets, that's what bear markets do, is that they rally up, they get everybody long, and then the winds shift and knocks everybody overboard. But man, I agree with you that a value of 21 is unsustainable right now, and it should smack back higher too. Let's look at the VIX. I haven't looked at the VIX today. Let's see what that dude is doing. So is it normalizing or is it coming back down? So look at this. We've only had a move up to 30. So 30, 31 or so, and we're well off the highs of the day. And we're above the upper Bollinger Band as well too. So that'll be interesting to see where that closes.
That's kind of the opposite of what you're seeing on the Russell, right? So your energy is getting out, and now you're up outside the upper Bollinger Band. That's a recipe to come back inside of it.
Yeah. So today we're looking at here was our opening range, and we've been above, for the most part, we've been above the upper expected move for today. And also, just to show the weekly expected move, we have the spiders here. We started out the week here, and here's our upper expected move. We're going to go anywhere from about 39.80 or so on the full S&Ps down to about 37.50. That's our expected move for the week, which is admittedly large, but tomorrow things are going to move. We're going to move Wednesday with a PPI. And we've got some other minor reports, but nothing really like what we have Tuesday, Wednesday.
Well, retail sales is going to be something. That's going to coincide with all this retails this week too. And that, not again something you think about, but that's been a market mover the last few times it's come out, because it shows consumer spending, and consumer spending is the economy, really. So that's one that definitely need to watch.
So the one, I guess my final comment on this move here, again, if we lose the 37.50 level to the downside, we're probably going to retest the October lows, which, at first glance, it's like, oh no, let's not do that. But I almost, in some ways, I hope that we do, just from the perspective of getting capitulation. This market, even though we've been in this bear market for 15 months now, we've never truly gotten one of these utterly horrible moments that causes capitulation. We've not seen a waterfall decline. Now, maybe some of that is due to the fact that we've had all these zero DTE options and everything is compressed within the space of a day, where people are not like trying to hedge these massive positions that they're holding for months at a time. So that may have something to do with it. But I've never seen a bear finish without literally a blowout to the downside. Never seen one of them do that. And so far, that's where we're at right now. So I'm very suspicious about any kind of a strong rally that we get from this point. And maybe that's part of disbelief, but it's going to have to prove it to me once we get to that point.
We're definitely more in the camp now that we get a strong rally that rolls over, right? That's definitely, with sentiment, where things have gone, and with this now issues with the banking system, we're definitely more susceptible to that and the whims of that. But again, the market will always do the opposite of what everybody expects. Well, I won't say always, but most of the time, the market will do the opposite of what everybody expects, right? It'll fade the herd. So whichever way the herd is going, it'll go the opposite direction. So if everybody's leaning on one side, it's going to go the other side. So there's potential definitely for it to rally and continue a rally. What you're going to need to see is, again, the Fed pause will help. We don't want the Fed to cut, not yet. But you're gonna need some other help. You're gonna need some other, type of data to come in. It could be CPI, could be jobs, right? Jobs could start going down, and unemployment can continue going up. That was one of the benefits to the jobs report last week, right? The unemployment continued to go up some. So that's kind of where we are with this right now.
What a strange world we're living in right now, where we're looking for negative numbers to support the market.
Good. Bad news is good news.
Right. It is. All right, everybody. Well, thank you. I wanted to thank everybody that's joining us live. Looks like we got a small pile of people out there today. So hello.
Hey, Doc, we did have a question.
We did.
Pull it up. I can see it on the app.
Awesome.
Yeah, we had it. It came in last week when we put out a note just to say any questions that you had. And let me see if I can find that question. Let's see here. What criteria do you use to select which index to sell premium on? Also, why would you ever consider selling premium on like IWM, SPY, QQQ with the higher taxes and assignment risk? So,
well, let's break that. That's a great question. Let's break that down into two different things. So, what index? So, part of that is Part of that will be instrument dependent. Part of that answer is technically dependent. So a lot of times we'll see something like the Russell gets stuck in a range, and the Russell can be a very good instrument for getting stuck in a range, as it has been for quite some time, right? So there's no one instrument that we say, well, the Russell always gets stuck in the range. Everything is in the process of just moving from expansion to contraction. And so what we're looking for is something that's more likely to be stuck in a range, or more likely to be in a contraction phase than an expansion phase where we're going to get run over, which is the opposite of if we were directional traders. So that's part of it. I think the other part of it for me is like, and Dave and I have gone back and forth on this. Like for me, the NASDAQ I kind of avoid, because of the option chain is not very liquid in terms of open interest. However, what I'm understanding from people that do trade it quite often is it's not preventing them from getting out. So I'm always very sensitive about what we call roach motels. Like you get into a trade and you can't get out. And that's typically something where you have that with some very low liquidity stocks that there's just no open interest on there. You get into a trade, you can't get out. So for in my mind, the two best indices for that would be the SPX and the RUT. So the S&P 500 and the Russell. And then number two behind that would be the NDX. And then the Dow, not really. There's no real index product.
There's no real good index for that.
That's really, really good for that. So anything to add there?
I'm similar in the sense that, like, I do like the NDX. And I like it because the volatility does help you sell out further. Remember, we're option sellers, right? We're not buying. And so there's the European style options. That's your SPX, that's your RUT, and that's your NDX. And to the questioner's point, those are European style, which means there is no early assignment, which is nice, right? You don't have to worry about early assignment. Now, typically, the only time you're going to get assigned is if you're in the money. Because if somebody calls you in and you're not in the money, they're losing. You're actually winning if they do that. So there's not a benefit to get assigned if you're winning in the trade and they're losing in the trade, only if they're winning in the trade, right? So I don't mind trading. I like to trade the SPY. I like to trade the IWM and the Qs, even the DIA. That's the only thing on the Dow that actually is a decent is the DIA.
Right.
I like to trade those. Again, it comes down to the setup. Every weekend when I do my analysis, I go through all of these and I'm looking for the absolute best setup that I can get, technically, as well as where the energies are, as well as where, like, from expected move, where I can put my positions, all that stuff, and get my desired return on risk that I'm looking for each of the strategies that I do. So it's going to be different each time. But I do find that for, like, my longer term trades, or even my double, like monthly trades, you can use the SPY in that. You can use the IWM and sometimes the DIA. They're much better for the longer term. If you're going 4 to 6 months out, it's easier to get the premium and sell at the levels. The SPX, the RUT, the NDX, better for those shorter term and midterm because you're going to get the premium at the levels. It's going to be easier. But they're all highly liquid, right? So that's I know you don't like the NDX for that, but if you look at, like, the SPY, the Qs, the IWM, those ones are always going to be much more liquid than even the Europeans. And the costs are less than the Europeans, right? The Europeans have a little higher cost too. So your trade costs are a little bit lower on those.
There's really two reasons that I would look at something like the spiders or the IWM.
Yeah.
And it's mostly around the fact that those instruments are 1/10 the notional value. So if you've got, say, like a $10,000 account, you really don't want to be trading the SPX, the big dogs on there.
Right.
So you do want to be, and it also, irrespective of the size of your account, what I typically tell people is the progression is when you're learning to trade, you want to start out on paper, get the mechanics down, understand what you're doing, so that you don't, like, stumble into the room like, are you guys playing cards? Like an Animal House routine, right? So you want to start out on paper and then migrate to the spiders. Just get your feet wet, and you're not going to be risking much. because you're going to use essentially narrow spreads on here, so you can't lose much. And it's a great way to sort of get the feel for what it's like to set up one of these trades, irrespective of the actual strategy that you're using. And then as you start to get expertise with that, as you start to build your account size, then go to something that is a bit more efficient, where the commission cost per potential dollar of profit is much, much less, with something that is more efficient and carries more leverage with the SPX. Yep. So even though you do have slightly more costs through exchange fees, it's more than weighed out through just the efficiency of trading that instrument.
Yeah, that's a great point. And so that's all things to factor in. So like when I'm looking at, what's the best one to sell, like if I can only get to, like I have certain levels I have to get to, and if it's only going to give me across the board so much, right? And it's between the SPX and the SPY, and I can get the same levels, and I get less credit on the SPX, but I can get the credit I need on the SPY, and it's going to help me reach put me in a position for my profit target, and it's the same levels, I'll use the SPY. So all that stuff comes into play that, from an analyzing standpoint on a weekly basis. And that's what we do. That's what we're teaching people to do. And, what we do on a weekly basis for students and subscribers. So.
Okay. So, great question. And, we welcome your questions as well, too. If there's anybody else that wants to, I don't know when the next time we're going to be traveling through the end of this week. I'm not sure when our next session is going to be. So, let us know though.
Right now it is slated for next Monday. So we'll obviously send out a note if that changes.
Yeah, I'm going to be traveling on Monday. So it'll have to be Tuesday.
So you're out. So maybe we'll get it maybe mid next week after the Fed will be a good time for us to get together on things.
Yeah, that's a good point.
How that goes.
Yeah, super.
Yeah.
So for those of you that are checking this out through a replay, we'd like to welcome you as well too. A lot of people are probably watching this on a replay. We can't join us live. So let us know, and we hope to see you next time as well, whether live or on the replay. So from Doc Severson and Dave Lukas, we have 12-minute trading. We are out for today. Good luck this week. See you, everybody.